Hey guys, what's going on? Welcome to Millionaire Mafia. Appreciate you being here today. Got a little bit longer video, but the reason it's so long is because I kind of wanted to bring you in on something that's a very important part of any entrepreneur's business model, which is making sure you've got the right people in place, specifically in this instance, your tax professionals. Whether that's your CPA, your tax strategist, tax planner, they can all kind of be wrapped up into the same firm, but you have to have all three of those in order to make sure that you are not paying extra taxes. Eventually, if you're super successful, you'll probably end up paying taxes. Not everybody, it's business dependent, things like that, but and the way you have your business structured, but you'll probably end up owing Uncle Sam something, but there's no reason that you should ever pay him a cent more than he's owed, right? The idea is to keep as much internal to your company so that you can continue to grow, right? And increase your wealth. So I'm going to do a video here. You're going to see basically just a raw conversation between myself and my tax strategist, Sean. Him and his co-founder partner, Chris, own a company called Integrated Financial Group, and I'm happy to give you their information. I'll link them in the description down below. They are a subscription-based tax strategy firm, as well as CPA. So, and they are member-based. So they do have to onboard you, and they have to make sure that they're the right fit for you and that you're the right fit for them. Inside of our company and in our partnerships, as well as my personal companies, I handle the kind of the nerd stuff, the bookkeeping, the CPAs, the tax strategy, the planning, the underwriting, talking to the lenders, things like that. All the boring stuff that's super important and vital, but that a lot of people don't like. It's not that I like it or enjoy it necessarily, but I really hate when those things are not in order, and it drives me nuts and it stresses me out. So what I'm going to do is I'm just going to go ahead and start this. This is quarter three. So the end of quarter three, moving into Q4 for year 2021. We just crossed over into October, but this was a couple days ago when I did this. So in this video, you're going to see me talking to Sean, and we'll be discussing basically what I call my tax glide slope. So coming from an aviator background, my tax glide slope. So where I'm at and what it's looking like for the rest of the year, where my businesses are at to help determine what my tax implications are going to be for next year. So my 2021 taxes that I'll have to pay next year. And then help me, the reason I'm doing that is so that I can set myself up this year to determine whether I need to buy something, whether I need to sell something or multiple things, whether I need to move stuff around. I just did a video and dropped that on income shifting, whether I need to shift more income over to my kids or my wife or myself in order to reduce my tax burden. And then also to kind of make sure that we got everything, all of our ducks in a row for the actual tax preparation stuff. Here you go. I'll kind of put a clip on the backside as kind of a review. And then again, feel free to hit me up with any questions. If you can, maybe drop a time mark for, hey, at this time, 25 minutes and 30 seconds, you talk about this. Can you explain that? And I'd be happy to do so either as a comment on this video, or as an email, or as a text, or call me, whatever you want to do. Hit me up on Facebook. More than happy to talk about it. Keep in mind, the professional is Sean. I am not a tax consultant. A professional. I'm not providing any legal or tax planning or financial advice. This is just me showing you how I personally am structured. So you're literally going to hear numbers that I have in my business, and I'm not really, I don't have a problem other people knowing it. And in this business, you really got to be comfortable with letting other people know what you make and don't make and things like that. It's not that you're bragging, but you have to know where you're at in order to figure out how you can get to where you're trying to go. All right, guys, check it out, and we'll catch you on the backside. How's things been with you?
Man, this is the last stretch for the 2020 tax filings, and it is. And dude, I gotta say, I use this word all the time now since I learned from it. It is a go rope.
Yeah, it's a good word.
Yeah, no, I love it. I'm probably using it incorrectly all the time. It doesn't matter. I just love I just enjoy it.
Yeah, it's a good one. It makes me smile. So it makes kind of take it a little bit, or I don't know, just kind of take a breath and be like, okay, man, I just got to figure this out. It is what it is. So.
Right. And thankfully I'm not, and there's nothing I deal with that is life and death. So,
right.
If we take a second, really sit down, let's, yeah. So it's good.
Yep. Yeah. So, well, cool. Well, I don't know if you have like a game plan for the meeting here. I know I kind of was the one who requested it. But I'm just trying to, the biggest thing at the end of the meeting is what I want to accomplish is kind of get like a 2021 tax glide slope. So I kind of can figure out based off what we know so far, kind of where I'm at. And I've had a couple things. I've had a couple things on the good side that have come up so that I think will help me. One of them being a couple partners and myself. Bob Preston, he's with me on Pine Village. He was he's my buddy and one of my mentors originally. But him and his group, Climb Capital, they have acquired an RV park here, and it's going to be about a $2.35 million acquisition. So I'm going to come in as another general partner. There's going to be 5 of us. So I'm going to be putting about $250,000 into that deal.
Okay.
And so the funds are going to be coming from a refi that we're doing on our office in Fort Walton. So we finally got that approved. Should be closing in about a week. Should be next Friday, which will be sweet. Pulling all our own money out of that, and then we'll be putting it into that plus my insurance policies. So should be already money that I've already basically paid taxes on, or that's not taxable.
Right.
So that'll be good. So that we'll do a cost seg on that, and we'll see how that one falls out year one.
And I'm assuming that's a 2022 type cost seg.
Well, it should be 21, shouldn't it? If we're closing in October.
Well, I mean, it's kind of your call. You can do it if you're closing in 2021. I mean, given this is not like a sub $500,000 property,
right?
The price point difference in a cost seg is basically immaterial. Mm-hmm. So really, it comes down to what's the best year to do it, year 1 or year 2.
Yeah. Well, and
so we got that planning.
Yeah. And at the end of the day, their company, their capital company, is going to be the ones running that show anyway. So I really don't have a lot of control over that. I'll have, I can recommend, but it's really at the end of the day, it's probably going to be in the year that best makes sense for them and their company. But I do know they have bought a ton this year. They're buying. I would imagine they're going to buy well over 1,000 units by the end of the year and sell. But they've also had quite a few sales, so that have had net them all out. They've had several $1 million worth of gains amongst the different entities. So
so they're looking for expenses immediately.
Yeah, and I think that's generally they're kind of in the same mindset as me, like get it now and we can just keep rolling it and do that type of thing, and obviously just keep it kind of almost forces you or encourages you to buy more, right? So it's kind of a motivator, a built-in motivator. So but anyway, so I'll talk with them about that. I think that's their plan. I was actually texting him just before you called, so but anyway, so there's that, and then the other big thing I want to get at the end of this is to make sure that the payroll stuff that we had talked about last quarter is set up for the income shifting stuff that I'm trying to do with my family, with my kids.
Yeah.
So other than that, I mean, I think that's really all I'm looking for. I don't really have any big questions or anything. Everything else is pretty straightforward. I responded to your email about the tax adjustment thing. I was just surprised to see it. I was expecting to see that next year. So I was just like, what's this all about? So
this is going to be great and not your issue at all, but there's been a lot. IRS has been sending out a lot of kind of this type of notices, and there's just a lot of matching issues, and they're both IRS is having issues internally as well as I don't know. Everyone's kind of had a weird year 2 years, and shit was just not as clean at every stage, and so it's gonna be fun cleaning this up over the next few years.
Yeah, I bet.
And I don't, and a lot of it has to do with the COVID related, like what you have the credit.
Right.
And it's gonna be a shit show tying these things out because it's just continuing. Like they have those, like if you have kids, they're giving you the extra deposits right now.
Yeah.
It all gets trued up on your tax return. I'm like,
Right.
all right. Well, now I hope they send some type of end of year letter. Then what about the folks that it's going in the wrong bank account or something, so they're not getting it, but they think they are? Like it'll be fun.
Yeah, we definitely, it's been about 3 or 4 months we've been getting that $1,000 or whatever. So,
right.
Which is, it's fine. I understand. Like it's just taking off what I get next year, but I'll take it early all day, and
And most people was fine. I mean, my situation was wonky because I was going to be claiming 3 kids instead of 2, and I didn't want to get too much of a credit.
Yeah.
So I held off filing my return for a while just because of that alone.
Okay.
But it's just going to be a weird few years.
Right.
It's going to, I don't know, just ride the wave, I guess.
Yeah, just ride the wave. Everybody else is doing it, so.
You have to. I mean, there's no other choice.
Right.
Whether you want to or not. So, yeah, I don't think there's really anything. They're just going to adjust the refund, if you will.
Yeah.
And move on.
That's fine. So the big thing with me, and we've already discussed this a couple times, is that it's kind of the unknown, because the good news is that separations pay, that money that I got back in June or July was taxed front side. So, but they taxed it like,
and they took a high percent. Was it like 30%?
It was like closer to 40%. It was like 35, because I ended up getting like 100, just over 100 grand, and I, based off of my calculations, I should have got just over 140. So they took a big chunk out. So the good news is, more than likely, I'll get some of that back based off of the cost segs we're doing and everything like that. So that's the good, because I was actually kind of stressing out about that. I was like, man, I've got another 100K that I've got to, figure out. And then I realized, oh wait, they've already taxed it. So the question is, how much of that can I get back? So that's good. But then I also did have a decent, so I'm still, on quote unquote on salary from FCRE. It's not much. It's $3,000 a month. I net about $2,700. Just for Tyler and I to have, basically have some income shown for our active, stuff. So which is fine. But then I had, for the first half of the year with, the Marine Corps, I made, basically half a year's worth of salary. So there was earned income. Now there was a lot of tax-free stuff with the, BAH and some of the other things that we get. So not terrible, but so I will have that earned income. And then,
well, where do you think that one falls in ballpark?
That should be about 50 to 55. Okay. That's I make about 110 a year with them, or was making. Right. And then, I started getting on payroll in February from FCRE. So just round it up, say it's, 35K for the year. We'll be on that one. And then, we sold the former rental. I was trying to sell it while I was still inside that 2 out of 5 year window, but I missed it. But, we ended up making about 30 grand more than I originally planned. So it worked out. But
you say how much? 30 grand more?
Yeah, we were going to sell it in November. And, just the market is just crazy. And it went up, and I actually listed it below market, but that was just because I didn't have an agent. So I was like, I was looking at the numbers. And it was in good shape, but I had some kind of lower quality tenants, but they wanted to buy it, and I didn't need to hire an agent, didn't need to do anything, so I saved myself 30 grand on commission. So I was like, I took like a 15K hit and so I basically had another 15K on top of that. So,
right.
But yeah, so I made 30, 35 extra on that, but the net proceeds was about 100 grand. So, and that's all going to be,
What property was that?
That was sick. Yeah, that was actually in my personal name, 6058 Meursault, MEURSALT. So that one, and a couple other ones I still have in my personal name, just a couple. What do with the payroll stuff, what do I got to do, or what do we need to do?
So I'm going to talk to Gallo on our team, see if she can set you up. Basically, you have to register with the state of Florida to do payroll.
Yeah.
And then from there, we just run payroll, give them a reasonable wage for the work they do. Because they're under 18, there's a few codes that would be done just automatically within the payroll system.
Mm-hmm.
But they just wouldn't pay any Social Security or Medicare tax until they turn 18. And then because they're not making nearly what you are, their tax rate's going to be either 0 or near 0. And whatever let's say your tax bracket is 24%. You would save 24% on every dollar you give them in tax savings. And then they would pay pretty close to 0 in tax. Throw it into a Roth, majority of that income into a Roth, and just let that ride out tax-free forever.
So what we did, and I know because we talked about this, I wanted to before, and you said I could pay them now, and we can kind of back roll the payroll, correct?
Yeah.
Okay, so we already did that, and what we did is I basically set up 4 whole life insurance policies, 1 for each of them, and so they'll be taking that, and then the thing, I control it until, so I can take the policy loans and stuff. It's still under their name and all that stuff, or it's under my name, but they're or I'm the beneficiary. It's their policy. So kind of the same concept as an IRA. It's basically it's essentially no tax, right? That was the goal. So because their income is so low and they're under 18 and all that stuff, and so they can dump that in, because what they did is they actually paid for the policies, and then we did it that way. So that's what we did. I don't know if it'll work or not, but that's what we did. I wanted to set those up. So either way, where their money went, I guess what they bought with their money doesn't really matter. It's because it's tax free anyway. So, so that's what we did. So it's a similar concept, but this way, and then we'll just
basically run some a payroll run. It kind of trues it all up, if you will. Think of it like a bonus.
Yeah.
And that'll just cover whatever's been paid thus far through the year.
Yeah.
And then get it on the books properly as a W-2.
Okay.
And then everything kind of takes care of itself. So I'm going to connect. I'm going to ask Gallo here, just to double check, because you're down in Florida. She's up in Michigan. I don't know how much she's worked in Florida.
Okay.
Lines of setting up payroll.
Well, here's the other thing. Like, we use Gusto for FCRE. I don't know if that makes more sense to do that. I don't know what the costs are. Tyler set all that up. Actually, his assistant set up. So I don't know if that makes more sense to do it that way and pay him. I don't know. I don't even know what the fees are for it. If it, or if it just
for Gusto. Let me see. You're doing this through FCRE, right?
Well, that's who we use Gusto for now, and he also uses it for real estate or REI SIP, but that he's got different bookkeeping and stuff for that. But yeah, so FCRE does Gusto right now.
What's the ownership percentage there?
70-30.
Yeah. All right, so it doesn't make sense to run it through there.
Okay.
So yeah, like that's where I'd recommend is Gusto. It's really simple to use, set up, and it just makes everything easy.
Okay.
Payroll costs is probably going to be somewhere between $600 and $1,000 a year. Just guesstimate. Don't yell at me if it's off. But that's just the cost to run the payroll, but you'll save significantly more than that in taxes.
Right.
If you're doing more than a couple grand in total.
Yeah, it's about 25 grand total that I'm paying the kids, so they get about a quarter of that, give or take. So they're getting like between 5 and 7 grand a year is what they're making. So, and the reason I'm paying because the policies, because my oldest daughter is a little older, so it's like 7,100 for her, and then my youngest she makes 50. I think it's 56 or 54, and that's just enough to pay the policies. We just pay them like cash for doing lawn, mowing the lawn here, or doing chores. So they get paid other ways, but that's their payroll for Momentum. So okay, so I should just basically go into Gusto and set up that way versus working with that other lady or whatever.
Well, Gallo should be able to. So the first thing you got to do before you set up with Gusto is register with the state of Florida.
Okay.
That's step one. Gusto they don't really help with that step. From there, once you're registered with the state, you'll get some numbers, right?
Okay.
Allowing Gusto to connect your account with the payroll run.
Okay.
Once we have that, then you create an account with Gusto, and as long as we have this done by December, it really doesn't matter. We're probably going to do one payroll run for this year, just to true it all up.
Okay.
And then next year, you'll have like a normal pay period, like you might have to file quarterly or something like that, in which case you can either set the kids up on a fixed amount, or maybe you track how much hours they're working, whatever makes sense, given what they're doing.
And I mean, that amount shouldn't really flag anything either, right? Just in general. I mean, it's not like I'm paying them $30,000 a year to do it.
No. I mean, as long as it's reasonable comp. I mean, if you got a 3-year-old that's making $30K a year, that's a big old red flag.
Right.
If they're doing work, and I remember minimum wage is getting darn close to $15 an hour at this point, so
right.
It's more than you'd expect.
Yeah, they're not. I mean, they're working. You've seen the pictures and you've seen stuff. You know, they work. So they not every week or every day, but they're working. So
right.
Anyway.
So that's reasonable, and it's just a reasonableness test.
Yeah.
I mean, another way to look at it is if you were to go out and hire a third party to do the same work, that's what you really should be charging. So if you know they're doing a job that you'd be paying minimum $18 an hour or $20 an hour just to get some labor to do the work you're doing.
Yeah.
Whether you like it or not, that is the reasonable wage. And just because it's your kids doing it, that doesn't change what reasonable wage is.
Oh, so I should almost be paying them more, potentially.
Yeah. That's what I'm really looking at. It's like, because you do a lot of work on various properties. You know what a contractor should cost for projects.
Yeah.
If you're underpaying them because they're your kids, no. I would go with a reasonable comp. What you would get if you were to go out and get a third party to do this work. That's what I'd pay them.
Okay, fair enough. All right, cool. Okay, so I'll wait to hear from. So is Gallo the name of the firm, or is that a person?
No, she's Michelle Gallo. She's on our team.
Oh, Michelle. Yeah. Okay, I'm used to the first names. Yeah. I've seen stuff from her. Okay, cool. So I'll wait to hear from her on that. Yep. And then, so is there a way to figure out, based off of kind of what I told you and where I'm at with the other stuff, like, or am I looking at because the biggest thing I want to know, am I going to owe taxes, or am I going to break even or have something coming back? If I break even or coming back, cool. But if I'm going to be owing, I need to figure out if I need to buy something else, or if I need to do another flip to pay for the taxes or something like that.
All right. Well, how about this? You got a lot of activity in various places.
Yeah, and Katie's still doing. She can get you the momentum stuff. We're at about. We're over 100K in expenses on our rentals this year for repairs, maintenance, materials, things like that. And she's tracking that all. I know you guys don't have that, so I can have her send you the QuickBooks stuff if you need it.
Yeah, that would be helpful, and even if it's just a summary.
Okay.
Hey, we're projecting 50K, 10K, whatever.
Okay.
That'd be good enough.
I'd say summer. Oh, you mean net profits or just our expenses?
Right, exactly. Net profits. Okay,
got it. Cool.
And then you said there's been a lot of emails. Do you know how much that cost seg is anticipated to come back as?
The one up north. Amount. The ones for it'd be around $20,000. We're in 16. It's 15 or 16, and then expenses. So whatever there is, I'm hoping their expenses aren't more than about food, lodging, plane. I'm assuming it's more than it's going to be around $20,000, maybe a little more, maybe a little less.
For the cost seg itself.
For the cost seg itself is $16,000. Because there's three of them.
Okay.
So they had to do one for each.
How much in total do they anticipate it as? The immediate expense, is that $20,000? Or?
Yeah, that's that $20,000 because it's 16 for the actual reports and the work and the labor and everything. But then the additional amount that's unknown is their tab for when they flew out there and stayed for the day or whatever. So that I don't know how many people they took out. I don't know how many hotel rooms they got. I don't know. You know what I mean?
Mm-hmm.
So.
Yep. Okay. So it's about, let's say, $20,000 for the cost of the cost seg, and then you're saying just $20K for the benefits, like additional depreciation.
Oh no, the depreciation should be like, and what did he have? It was up there. It was like almost 600 grand. I thought for the.
All right. That number sounds more like.
Yeah. Okay. I wasn't. Yeah. Hold on. Let me find the one from Philip. It's right here. I got. Cost. We went back and forth a little bit because we had to change names.
Yeah, I mean 600K looks reasonable. Given I just found the purchase price. There you got over $2 million.
Yeah, exactly. So
what's your percentage of ownership?
20%. I own 20%. Yeah.
Between the two, that's knocking out. And are you paying so you're also getting 20% of the cost seg cost?
Yeah,
right?
I should. I mean.
Yeah. Okay.
Yeah.
I was just.
And then the other one. Speaking since we're on cost seg, the Stowaway one that was a sub 500K purchase. That was the storage facility we bought here back in March.
Mm-hmm.
I know I wanted you guys to do it. I don't know if we ever got it. I think last we talked, it hadn't been initiated, which wasn't a big deal, but I want to make sure that one gets done and what information. I know I sent you the information for Hollywood. I don't remember if I sent you or if I got the kind of that form that you had for Stowaway. Mm-hmm. So I don't think I did.
Let me see here. Because this was a 2021 purchase, right?
Correct. We bought it in March. It might be. Maybe you did it and it's in the files. I just didn't even notice it. I get a lot of emails.
It's just down at the bottom. I'll double check you can see it.
Okay.
But let's see. This is the property address is Alicia Drive.
Correct. Yeah.
Okay. So I'm seeing a cost on the settlement statement of looks like a purchase price. Charges to borrow $185K.
Yeah, that was the purchase price. Yep, and then we ended up putting $50K into repairs and maintenance, and we had another. So it was like a $250,000 total loan, but we had $50 allotted for capital improvements and stuff. We put in a new gate, did landscaping, fixed doors, things like that. And I can send you those invoices if you need them.
Yeah, it might help, just because if I can just write it off the top,
okay,
and not throw it through the cost seg, I'd be happy with that.
Okay.
But at least for our purposes of the estimate, so, and you own this thing 100%, right?
No, I'm a 1/3, so it's me.
1/3.
Yeah, me and two other guys.
Let's go 16K cost seg. All right, so you're looking at 140 in cost seg alone. So that eliminates your marine separation income almost completely. That throws you back with, you've got the marine income before.
Yep.
Plus, let's say 35K-ish for your FCRE wage. That puts you at, 90. So that's 35. Oh, come on, where'd you go?
And then we'll probably do about 550 for FCRE. Net, we'll probably net about 400, and I'm 30% there, so it'd be about 120 from FCRE. From the actual, from owner distributions type stuff.
Right. Well, remember, it's not just distributions. You've got
right.
Whatever the company makes.
Right.
Regardless of distribution, whatever the company makes, your share.
That right. Yeah, I spoke correct. So that's what we should net about 400K profit for the company.
Right.
So
okay.
I'm 30%, so that's 120. So that's
okay.
Yeah. That's estimated. It could be a little bit more. It could be a little bit less. Depends on when we just closed on a couple properties, so it depends on when we get them done. If they get done this year, cool. Then if not, then it'll be beginning of next year. So.
Same thing from real estate holding. Going to be how's that one looking?
So real estate holding is going to kind of, and that was another thing I need to talk to you. So when we close on our, because it right now owns 2000 West Gregory, but it also owns the office in Fort Walton there, 215 Hollywood. And when we close, we're actually splitting that off. So 215 Hollywood is going to be held by or owned by Dojo LLC. So that'll be by itself. And then 215 or the 2000 West Gregory will be the only thing that Real Estate Holdings owns. But real estate, to answer your question, for the year between the two properties that Real Estate Holding essentially owns now, I don't. We'll have about a net because we didn't even rent that thing out. So let me see really quick. 7 times, call it 6. Nope. So 35 plus about 15. So I probably have about 50K net profits. Probably 40K net profits. But that, I mean, we had a lot of expenses still. I haven't looked at the books on Real Estate Holdings on the because we put a lot of work rehab wise into the property in 21. So because we put new HVAC, new roof, rebuilt the whole thing. So we put 110K into repair or rehab / repairs this year. So I know that because that's what Tyler. Or no, I'm sorry, not 110, 160K. So we put 160K total into it. Yeah. Plus, I don't know. We did the cost seg for 2020. Sorry, 2019. Yeah, 2020. I can't remember what year it is. So
2020.
Yeah. So I don't know. So in year 2, how does that? When you do a cost seg in year 2, how does that look? Like what?
I mean, you go back to a more normal. Let me see here, because you get a nice pop in year 1, and then you kind of get into the more normal depreciation on your longer term assets. Which
okay.
Let me see if this is. Yes, this is 27-year property. So beginning next year, or I guess 2021, you'll get about 5,400 in depreciation a year, as opposed to the really nice pop of almost 57K.
Okay, gotcha.
Last year. Yep. So with the net of all that, I mean, you've got a little bit of CapEx. It sounds like of improvements. Like if you're completely replacing a roof and completely redoing like plumbing and stuff like that, some or a lot of that will end up as CapEx.
Yeah.
Appreciate. You said what was the profit you were thinking?
About, what would I say? Probably 45 for the year.
Okay.
That I don't know that, but again, that's gross. That's like the gross profits from rental income.
So is that 45K including expensing like all of that 100 and some?
No, I haven't even factored in the 160K in rehab.
Oh,
that's what I'm saying.
So all right. So if I throw 20K as your 50/50 owner,
right?
That's actually probably rounded off. Okay.
Right. Yeah. So we put, like I said, when we did this building, it was essentially a gut. Like we didn't have to replace the drywall in most of them. Some of them we did. Some of the space, but new roof, all 3 new brand new HVACs, hot water heater, like completely ripped all the flooring. Everything inside is new. So, and then we also bought furniture because we were going to Airbnb these. We ended up not. So we own all the furniture. We own all the appliances and all that stuff in there as well. So.
Okay. And now they're long-term rentals?
They are. Yeah, for now, in 2022, we might end up switching back over to Airbnb. We just missed the Airbnb season was the problem. So we got finished with rehab at the end of July. So we were like, let's just do long-term stuff. So.
Yeah.
But yeah, anyway, it's kind of really.
You just have a mix. A couple options for Airbnb and see how it goes, and then have some consistent long-term.
Yeah.
Although the monthly isn't as good.
Right. And so REI SIFT and FCRE rent downstairs. So we each pay, we've kind of adjusted. It was just under $900. Now it's $1,375 a month each unit. Each company pays. So it's kind of like, left-hand pay on the right hand, but just that's in there as well.
Yeah, but it helps on the lines of your overall tax.
Right.
It's a better source of income.
Yep.
All right.
And honestly, I think Momentum is going to be at a net loss for the year because of all of the repairs we've done, because we haven't really we've netted income, but we've had a lot of new like rentals that we bought, so I don't know how we want to expense that out, if we want to just so what let me tell you this, with Momentum, I've had Katie put all of the repairs towards expenses versus the basis, but they're all categorized. Like all the expenses are to the unit. So if we need to go in and add them to the basis versus expense them out, we can do that. We just haven't now, because I knew that this year was going to be kind of a heavy income year. So ideally, I don't know, I don't want to get in any trouble or do anything unethical. That's why but that's the way we did it. So that way, when you look at it, like some of it was legitimate, like after we got tenants in, and I have, leases and everything to support, when the tenants entered and stuff like that. But honestly, for the majority, most of it was like rehab costs. But ideally, I'd like to expense those out. They were CapEx improvements though, because they were, shit.
I mean, this one's a tough call. We have to kind of go over the details, but
okay.
The easiest one is that $2,500 mark. If an overall cost is under $2,500 for a repair, doesn't matter what it is, it's auto expense.
Okay.
The other factor, and this is usually for multi-unit, multi-door properties, more than like a single unit.
Mm-hmm.
But if you've got, let's say, 10 air conditioner units on a property,
yeah,
and you replace 3 a year, you can expense them immediately. The ones you do replace, whereas if you go through and replace all of them or more than 30%, so let's say 50% of them a year,
mm-hmm.
then we have to CapEx it over 27 years.
Okay.
But that's when you have like many units of property. Most properties you can look at windows. Like if there's 20 windows in a house and you only replace 6 of them, yeah, that's expense.
Okay.
Whereas if you do the entire house of windows, damn,
yeah,
you're stuck with capitalizing.
Okay. Well, I'll probably end up having to set something up with you and Katie just to go, because she's the guru on that one. So and I'll just have her set something up with it as we get closer to the end of the year and everything, or maybe even, we're just tracking. It can be early next year too. It's before. Right. So I'll just let me know when you want or need to talk with her, and we'll go from there. But for now, just so you're aware, we're just going to expense everything out and assign it to the individual units, and then we can figure out what needs to go towards CapEx versus what just goes to repairs and stuff like that.
That's not a terrible issue.
Okay, cool.
All right, let's see what else we got. Anything wonky that I should be worried about on Happy Lane? And you sold, was it Mersalt?
Yeah, I sold Mersalt. No, Happy has been pretty much just minor repairs, and I got new tenants in there, so that's just pretty normal one. That one hasn't had anything really done to it.
Okay, so I'm going to assume same as last year.
Yeah, I raised rent like $50, but other than that, it's going to be pretty much the same. So.
Man, we quickly ran through all of it. You got a lot going on, but we quickly ran through it.
Yeah, well, I'm relatively organized, believe it or not. Even I'm not the most organized. So.
Yeah, you just got a lot going on.
Yeah.
Okay, so here's, if I were to add up all this stuff, it's a solid year. So if I add up everything, so I'm just going to quick run through. Happy Lane, about $2,000 in profits. Nothing for Momentum. We're just going to assume it's break even.
Yeah.
For now.
Yeah.
Real estate holdings, $20K is your share guesstimate.
Okay.
FCRE, same thing, $120K, your share. You had $55K before you got out, another $140K after you got out of the Marines, and then FCRE, you're getting wages of $35K-ish for the year. And then Mersalt, and just double checking, we got $100K in profits, right? Is that $100K in profits, or is that?
Yeah, that was in profits, and I didn't add in the rental income up to that point, but that's probably about another. Just make it 105 in total profits for that one.
Okay.
Because I forgot to add the rental income for up to that point.
Right. So that makes it very healthy profits before we start whacking out some major deductions of just short of 500K. So
right.
Terrible year.
Yeah, I know.
Terrible year. So then if I subtract out our costs, segregations, stowaways, cost seg, and we're still at a very healthy 340K profit for the year.
Okay.
That's big boy. Good job, man.
Yeah. Doesn't feel like it. I don't know where all the money went, but it doesn't feel,
Yeah, I mean, it's just kind of, you're in this vicious cycle right now where you're growing. So, for example, where the money goes, you told me that you dropped 250K into this new RV park. I mean, I know you took out some various loans and other things to get it, but in order to improve all those properties and get them to the point where they've appreciated value, you probably threw a bit of money into them in the first place.
Right.
To get it. So, yeah, it's, okay. And in the RV park, you said that that's a 600K, no, that's different.
Yeah.
You said that the RV park has a potential cost seg study on that one, right?
It should be, yeah. So it's at 2.3.
What's the ballpark of the cost of that property?
2.35 million.
All right. And then what's your ownership percentage?
I should be between, let's just call it on the low side, say 15%.
All right. So there's another, let's say 58K.
Okay.
All right. So now we're at least sub 300. We're at 280.
Okay.
Better.
Does that include the 20?
How much you paying the kids?
25 total.
Total?
Yeah.
All right. 254.
Okay. That includes the 21 carryover from last year?
No, it does not. Let me see. What is that going to be applied? Well, 25 or 20K carryover you're talking about?
From, I forget what the exact term is, from this year. So basically I was negative 21 income for the year.
Oh, okay.
What do they call that?
I'm seeing an AGI of 77, so I'm not seeing any carry forwards of carry forward loss. I am seeing some QBI carry forwards, but that's not going to help.
Okay, maybe I'm looking at, I don't know. Okay, either way, maybe I'm looking at the wrong thing.
I mean, you were able to, what happened is you had some losses that was actually absorbed in 2020.
Okay. Now, with me filing as a real estate professional helping anything on this, or?
Oh, yeah, it's a huge. I mean, that is everything, because otherwise all these cost segs would likely be caught in tax limbo land. Oh, okay. And then you'd be really grabbing your ankles.
Okay. All right. So I need to do well, that kind of sucks still, though.
Mm-hmm.
Man. All right. What is that gonna equal? I'm at what, 254 then right now?
Right.
Well, okay, hold on a second. That 140, remember, was already taxed out.
Right. That's just your income. So 140.
So we really got to take
as a top line.
Yeah.
And then you're going to have amounts paid in of about 40K. That's going to reduce your overall tax liability.
Okay. Yeah. So.
But it's top line. So let's say everything like this, that our big rounded numbers is perfect. Not close. You'd be taxed on the 250K here.
Mm-hmm.
Whatever that tax comes out to. What is let's say that comes out to, so let's say that's about 45K that you'd owe in taxes total. Okay. That's at an effective average tax rate of about 18%. You already have 40K dropped in through the withholding.
Yeah.
So you would have to collectively come up with an additional 5.
Oh, that's not so bad.
Right. That's what I'm saying. Like, it's not a subtract from the lines of your income, but it immediately drops dollar for dollar any taxes calculated as owed.
Okay. Well, honestly, that I was having a little bit of a heart attack there on the 254 because I mean I could get it like I'll make that that much.
That's not your tax. That's
I know.
For the year. Yeah.
I know. I've never had that much as as an AGI before. Like quarter of that at most. So I'm like, ugh.
Right.
So, and then I've already received, or I will have already received all the child tax credit, so that won't help me at all next year, right? Because that'll be.
Well, you'll receive partial, but you're also going to get stung because we're probably. Honestly, I want to run some planning strategies for you.
Okay.
Like actually run some numbers because we might be walking into. You're getting phased out of some big credits.
Oh.
And so let's say a $20,000, $50,000 investment in like an alternative investment that gives you an immediate deduction drops you down from a relatively high AGI of 250 down to something sub 200, right?
Mm-hmm.
All of a sudden now, bam, all those child tax credits come back in. Your tax rate goes down. You get these surprise credits that come back into play, and your tax liability drops near or at the cost of this, above the cost of this alternative investment.
Okay.
And then that gives you, that just gives a nice return on investment. And depending on the type, you might actually get an asset out of the deal.
Okay. Got it.
In the future, you're going to make money.
Yeah, that would be beneficial. Okay, I like it.
So that's where I'm gonna run all this. I'm gonna have my team run some projections for you. It's gonna give us a little bit because we're just friggin' hammered right now.
Oh, I know, I understand.
But what I want to do is see where, like, I'm just guessing with that 45K. I'm just using a reasonable average tax bracket.
Right.
I want to throw all of this onto like a mock return and see where that falls, and then also see, like, okay, given this, if I drop your income by 50K, 100K, whatever it is, how does that affect your overall tax liability? Because there's certain points where it makes a small change makes a really big difference.
Okay. Gotcha. Well, cool. All right. Well, hey, I appreciate it, Sean. That was good. Good. I know that's just kind of rounded numbers and best guess, but I appreciate all the info, so that'll help me out, kind of figure out things for the rest of the year. Honestly, I'm kind of tapped at what I can buy with my own stuff, so I'm gonna have to tap into some private money to buy any more properties. I could do cost segs or anything like that to help me out. But it looks good. It looks good. I appreciate it.
Right. And the good news is, it'd be one thing if you're buying these properties, getting a cost seg, and then they're like just kind of flatlining.
Right.
But you're making money everywhere. I was waiting for a loser in the bunch, and you didn't have it.
Yeah, I might not do the volume that a lot of people do, but I try to make sure I buy winners. So that's typically what we're shooting for. So that's the way,
These RV parks, man. Between you and two other clients, like, this should have really been a shocker. It's like, oh my gosh, these are cash cows. I never realized the RV park where the truck in front of the RV costs more than the RV itself. It's cash king.
It's pretty amazing. I wish I would have gotten into the more recreational RV side, not like the RV mobile home park side earlier, because now. So the mobile home parks have kind of become old news. Like, everybody knows about it. RV parks are becoming that way. But like before, a couple of years or so ago, like RV parks, I mean, I wish I would have delved into that. I was so focused on up in Gary and some of the other stuff and getting out of the Marine Corps that I wish I would have bought a few other RV parks. This particular RV park that I'm partnering on, I actually was talking to this seller for a while ago, and I had him at a lower price that I could have bought the thing, like, not by myself, but I could have been the GP or the principal on this one, and I'm kind of kicking myself. But it'll be kind of nice to just throw money in, and while I will be a general partner doing some work, it'll be kind of nice to just get a return versus having to do all the legwork, because I'm getting a little tapped out on my bandwidth. So
Yeah, that's always a limitation.
Yeah.
But yeah, no, I mean that's the beautiful thing. I mean, your problems, and trust me, I understand, because you're looking at it like, oh my gosh, how do I make this type of money?
Yeah.
Where's the cash?
Yeah. Right.
It has to do with, and we're dealing with this internally as well. Growth is expensive, okay, in any industry. It doesn't matter, because you end up front-ending a lot of expenses, cash, whether that's to make a deal happen, buy inventory, get equipment. It doesn't matter your industry. There's always a front-end cost for growth. And then on the back end is where you're like, oh my gosh, now I'm growing. But in the middle, you start off and you're growing and profits come in, but then you immediately spend it on something else, and it's not always an immediate IRS expense.
Right.
Which is where you're probably in some pieces falling, because you've dropped some cheddar on various properties.
Yeah, we spent a lot this year. I mean,
Right.
So that was my biggest concern, is did I overextend myself, because I've never had to like come out of pocket on paying taxes up to like ever in my life. So I take it back. I was a 1099 when I was in high school for a couple things, but that was child's play, right? Yes, but I want to make sure that I'm not slowing down the growth of my business by not planning for the potential tax bill next year. So because that I don't want that to come as a shock. So
right.
Yeah.
Run into a situation where you got to come up with $100K in cash for a bill that you weren't expecting.
Right.
And it just crushes a few opportunities.
Yep.
Yeah. Yeah. I mean, I you hit with the RV park. It's kind of interesting. I mean, I'm in South Bend, right next to Elkhart, which makes all of them.
Yep.
And that thing's been going batshit crazy. Like, I have a couple of clients that are actually building those things.
Yeah.
If they could triple their capacity, they would sell every single RV.
Oh yeah.
It's ridiculous.
Look at all of the storage, like the ones that have outside storage, like for boat and RV storage, and they're packed. Like you can't.
Yeah.
And just in the last couple of years, they've absolutely exploded in boat and RV storage, specifically the RVs.
You know what? That's actually the play right there, because there's a lot of mother suckers that can afford it. They don't want that giant hulking RV sitting at their house.
Well, and they can't. A lot of them because of HOAs. HOAs have gotten, with all the new developments going on, they all have HOAs, so they're highly restrictive, and they can't fit them in their backyard, or it can't be visible even from the backyard, so they have to store it, and that's typically what's happening. Yep.
So expensive, man. RVs to me are like boats, right? There's two best days for both of them: the day you buy them and the day you sell them.
Yep.
They just seem like such a waste of money.
Yeah. Well, so if myself personally, or if you were to ever buy an RV versus a boat, the advantage is I would 100% be renting it out to people. So like my dad does that.
That's an Airbnb. Like when I leave South Bend, I'll probably end up in Nashville, and straight up, everything except for the tiny little sliver of my property that is my personal residence, that thing is going to be business, right? I'm going to have little cabins all around the property. Like, I'm going to figure out a way.
Yeah.
It's going to be a farm. I was just talking to a guy. It's nuts. It's real fun to talk to entrepreneurs all over the country. This guy he buys large pieces of property. This is just a small piece of everything he does.
Yeah.
But I think it's like 80, 100 acres. He drops like 20 grand on oaks to plant them.
Okay.
Now, it takes a while to get your money back, but that 80 grand those oaks will eventually turn into $1 million 20 years later.
Yeah. That's actually what Nelson Nash, he did the Becoming Your Own Banker books and stuff like that. He just died recently, but he grew up in the forestry industry, and then that's how he equates his insurance policies, like how they grow, and that you add, it's a decent kind of expensive up front, and it takes a while for you to get your actual return, but once you do, it's amazing. So
and he's like, I'm doing hardwoods because they don't do the swings, and worst case scenario, I just leave them in like not too long ago, like pine like the cost of pine was through the roof.
Yeah.
It wasn't at the farmer level. It was actually all at the like the sawmills. That's where the price was going through the roof.
Right.
So he had a couple other properties that were pine, and he's like, I'm just letting them grow. It doesn't matter to me.
Right.
I can wait. It's going to turn in a few years, and then I still have pines.
I'll have to pick your brain on that or get in contact with that guy at some point, because that has always has interested me the last couple of years since I got into the insurance and stuff. I started my own policies, and I like having land. And you could do a couple of things. You can land lease it for hunting. You can have.
Yeah, like it doesn't limit your, like he's using it. It's a farm. So it's his. He lives in like one of those HOAs. It's a beautiful HOA. He's doing well for himself, right?
Right.
But he's like, you know what? I get tired of the city and the bustle and everything else, and I just need to go out and shoot my shotgun.
Yep.
And just that nature, right? That relaxation.
Yep.
So he's like, yeah, we stop in. We've got a piece that's slivered out. That's our like rent. It's like a vacation. Property, personal, that's fine. But then the rest of the property is in some way, shape, or form a business. Now, not all of it can be expense because there's a bunch of land.
Right.
But everything he does, he mows the property. He pays farmers to plant the trees. The whole thing is a business.
Yeah.
So,
well, and it's zoned ag too, so I'm sure. So he doesn't have. There's hardly any taxes like. State or county taxes, property taxes. So
right. And there's a little, but there is a cost.
Right, a little bit.
And then when you're looking at like a 20-year turnaround, I mean, it adds up over the years.
Mm-hmm.
But it's nothing compared to that growth of profit. And I just can't imagine something that has a limited resource like a tree. I mean, if anything, that's going to be more valuable because they're trying to change the business. Like products and everything to be more sustainable and whatnot. Mm-hmm. It's fucking trees, buddy.
Yeah, right.
I saw they're starting to build like skyscrapers, not skyscraper, maybe 7-8 story buildings out of all wood construction. And they're doing something funky with the wood so that it's strong enough to hold that type of weight, but it's still wood.
Yeah.
And where'd it come from? Same tree farm that he's growing trees from.
Right. Yep. No, it'll be huge, and that's something that'd be fun to own and work too, and you can pass it on to the family, and you never have you don't have to worry about the HR issues like the trees grow and they don't complain about it. It's grow. That's it.
Right.
You don't have to pay them. You just pay to be able to maintain the property or own the property, and it grows.
So, anyways, man, I really do appreciate the call. I'm gonna get this in, get our team working on it, try and get you some kind of follow-up numbers, like real, not just a guess.
Okay.
And then also Gallo, she told me she's going to probably reach out to you here shortly to try and set the payroll up.
Okay. Sounds good, man. I appreciate it.
All right. Yeah, you have a great day and good job, man. This is good stuff.
All right. Well, thanks, man. I always enjoy talking to you, so it was good catching up too. So.
Yeah. I do as well. It's never a bad call. So.
Right. All right, guys. So, unfortunately, the last couple minutes there and the first couple few seconds cut out. The last little bit was just me getting off the phone with Sean, and then the first couple minutes was me trying to figure out that you missed was just me trying to figure out this online portal that we were trying to use for like a group meeting, and it didn't work, so we just ended up doing a phone call. So I just didn't get the camera going, but you really didn't miss any of the meat and potatoes of the meeting. I'm trying to be an open book and fully transparent so you can kind of see how these things go. As you can tell by that video, I had a little bit more of income than I planned or that I really expected. So just kind of big, broad brush strokes. So good things. I had acquired a lot of properties this year, whether it was multifamily, the storage facilities, the apartment complex, have another big RV park getting ready to close here soon. A couple other, single families that we've bought to flip, but have a lot of, at least on paper, income, right? So it doesn't necessarily mean that that's all in my bank account. And I can guarantee you, if I showed you my account, it wouldn't be that much, that $255,000. What I have done And what my W-2 job has allowed me to do, now granted I am out of the Marine Corps, but just for a couple months, but that allowed me to live off of a salary, right? But be able to plow everything right back into the business. There's a lot of schools of thought on take your profits first, and make sure you pay yourself first, and all that kind of stuff. And I don't think they're bad. I don't necessarily disagree with them. However, I had the opportunity with that W-2, and that's why W-2 is so powerful, and why I do recommend to most people to keep your W-2, whatever that is, as long as possible, because it not only helps you keep a steady paycheck, but it also helps you with loans, and looking good with banks. And I'm seeing that right now, not so much on the commercial side, because they're looking at you as an investor and they expect that the people that they're lending to or working with are entrepreneurs, and so that their income comes from rental or business income. But I have a couple properties that I own in my own name, and so I'm getting loans on those. The advantage is that I can get a 30-year fixed rate mortgage for these properties. The disadvantage is that they're under Freddie Fannie guidelines or rules, and it's a very, very strict and very, very constricting as far as what they can lend on, and that's based off of your W-2 income. So your debt to income ratio. So because I don't make that much, I only make about $3,000 a month for my employment with one of my own companies, it looks like I only make $35,000 a year. Well, on paper, that looks pretty bad when you're trying to take out a $100,000 loan. It doesn't mean that all my other income is useless, but a lot of it comes from other companies. Remember, the bank is lending on me, Jake Chambers, not on Momentum Investment Group or my real estate investment company or some of the other companies that I'm a part owner of, but not the actual company itself, right? If that makes sense. So they don't really, it's not that they don't care, but that they just can't factor it into the equation, right? So that's something I'm struggling with right now. I've never had to deal with that. So that's another advantage. But anyway, you saw that at the end of the day, I had about 250, or it looks like I will have about a $250,000 taxable income. That would equate to about a $45,000. Let's just round it up to a $50,000 tax bill. Well, that's not that huge. I say that not being not lightly. I think that's still 50,000, but some people will have hundreds of thousands. Some people, that are doing really well, especially depending on their source of their income, could have millions of dollars in taxes. So if you're not prepared for that, that could absolutely destroy you, and at a minimum, drastically impact your growth or your momentum, right, as you're going into that following year. If I got to pay a $50,000 or $100,000 that I wasn't expecting, I gotta figure out how to pay that, because the IRS is going to get their money, so they got to get paid. So I don't want to have to sell an asset or not buy an asset because I can't afford to pay my taxes from the previous year, right? So if you heard him, and what happened is, one of the things that happened is back in July, when I got out of the Marine Corps, I got a separations pay because I was involuntarily separated. So it's basically a severance package. The total gross was about $140,000, but I only received about $105,000 of that. So they taxed about $35,000, and that was actual tax. So they've already taken off $35,000. I think I said 40 over the phone, but it's actually going to be about 35. So of that, let's say $50,000 that I'm going to owe, we take off 35 right off the top. Now I only owe $15,000. We said $5,000 there because we estimated it was only $45 in taxes, but I'm just going to round up, say I owe $50,000 to be safe, and then so I'll owe $15,000 in taxes. Now there's some other things a couple other things, like I get to write off a certain percentage of my house because I have an office. I'm sitting in it right now. It's about a quarter of the size of our house. And there's some other expenses that we're going to be able to write off, I think, as well. I actually may be negative on my personal investment company. And so I think when it all is said and done, it'll equal out to about what we anticipated. So some things I may actually owe a little bit more taxes, but some things I may actually have less income. So I think it'll all even out. So at the end of the day, I'm anticipating probably having about a $15,000 tax bill. And I'm doing this. This is the end of Q3. So moving into Q4 of 2021. The reason I'm talking about this now is so that I can prep for next year, because this is what I'm anticipating paying in taxes. So the good news, I can plan. So in 2021, 2022 for 2021 tax purposes, I need to have another $15,000 of income set aside that I don't right now to pay off my taxes. Or another option is I need to buy another asset this year and then do a cost seg on that property in order to be able to expense out essentially $15,000. So that's the other option. That's probably the best option, because not only do I get another asset, but I also reduce my tax burden. And then you might have heard Sean talking about how because I'm at 250 and I'm actually over that child tax credit like cut off, to where actually that child tax credit that a lot of us are getting in our account just automatically without doing anything, which I'm getting as well, and they're going to want that back. Well, if I'm able to put my money in that 50,000 into something which would reduce my tax, that's immediately tax right off. Let's call it a utilities company, or some type of green energy, whatever the government gives an immediate write off for. I can basically expense out that 50 grand of earned income off of my total, which will drop me below that threshold. So not only will I be able to get an asset that will provide income for me, $50,000, whatever that is, we haven't really specified that, but I'll also get to reduce my income to where that tax credit that I got will stay in my pocket. I won't have to pay that out. So it's kind of a double whammy on the good side. So that's what he's going to go figure out. That's what he mentioned with his team. It's the end of September, so they've still got a couple weeks of the mad dash for taxes. And so I'm expecting to get that probably end of next month or something. So no big rush. I'll try and update you once I find out. I know that was a really long video. I hope you're able to watch through this. This is a conversation you need to have every year with your tax consultant, your tax preparer, your tax strategist. That's why we went with this company. The company name, I'll link them in this video in the description, but it's Integrated Financial Group. They do a really good job of keeping up with their clients, and you just heard some of the conversations I had. Not only is he helped me figure out my tax glide slope for next year, but we were talking about how another client of his, and that's why you gotta be listening, how he uses his money, his own property, and then puts a little bit of money into it to grow trees, to then down the road be able to harvest that and sell off the trees, the wood, and make a killer profit down the road. Now it's a long-term game, right? 20 plus years, like you said, but if it's gonna be land you're gonna own anyway, why not make money for you? And that's the key. That no matter what you buy, whether it's an RV, a boat, a plane, land, a building, that you make it make money for you, even so that you can also enjoy it personally. But if you're going to enjoy it personally, make it make you money, or be able to at least reduce the amount of taxes you have to spend. I hope you guys got a lot out of that. I really enjoyed making this video. It was pretty cool. It's always, I don't know, the taxes and reducing them is really fun to me. I geek out on that kind of stuff because it's like a puzzle, right? So if you like these kind of videos, please go ahead and mash that subscribe button. I want to see you guys here on a regular basis, and tell everybody else you know about it, because I'd love to have them in here and be able to show them these types of videos. If you have any type of questions or comments or anything like that, please hit me up on the page. If you know my own number, I'm happy to give you my phone number if you reach out, and we can discuss these types of things ad nauseum, because again, this really excites me. All right, until next time, guys, here's to your wealth.